You can use more than just your basic salary or hourly rate when it comes to your affordability for your mortgage. By using some variable earned income such as overtime, commission, car allowances, unsociable hours, bonuses, it can increase your affordability, meaning you could be able to borrow more. By borrowing more, you could go to that next level home, which means you do not need to move as often, which could save you thousands in fees and moving costs. Hi, I'm Jenny from Your Mortgage Hub, and I'm here to help those starting out and starting over by showing what you should and shouldn't be doing when it comes to applying for a mortgage. I had a couple of clients who were looking to get back onto the property ladder. They had been off the ladder for a few years now, but they'd found their dream home. By the way, they should have come to me first of all before finding their dream home. But anyway, they didn't. So they were using the lenders' calculators online and trying to work out if they could afford it. Now, they knew they could afford it because they knew how much rent they were paying, and that was extortionate compared to what they thought the mortgage payments were going to be. However, the lenders' calculations were saying that they couldn't afford it. They were working really hard and they worked long hours and they had various amounts of incomes coming in on their payslips, but they weren't calculating them into the affordability. So after a discussion with me, I looked at their payslips and I could see that they were receiving car allowances, they were receiving overtime and unsociable hours, and all of these could be used towards the affordability. They could be used because they were being paid on a regular basis and they were being paid for roughly the same amount each month, and it also tallied with the end of year figures. So after going through all of their payslips and their documents, we went back to the lender and we said to them, this is the income we want to use. And the lender looked at it, was able to justify that that was income was going to go on for the foreseeable, and it meant that we could go back and use the higher loan amount. That meant they secured that next level property, and it means they're only going to be moving once. They're not going to have a stepping stone house that they then have to move again and have even further fees to do that. So here are 3 things to consider if you're wanting to use your variable income when it comes to applying for a mortgage. Number 1, a lender is going to be looking for your income, and they're going to be looking at your pay slips and they're going to average that out and annualize it. Now, if the income is paid on a monthly basis, they're going to be looking between the first 3 to 6 months. If it's paid quarterly, they're going to look at the last 4 quarters. And if it's paid annually, they're going to average that out over the last 2 years. They will make sure that that tallies with your end of year figure or your P60 figure. And if it does, they're going to be happy to use that as part of your affordability. Number 2, each lender will use the variable income in a different way. So you might have one lender that will put it all into one pot and will use that at 100% of what it works out at. And you'll have other lenders who will separate them. So they'll have their basic income that you'll use at 100%, and then they may use your variable income, so your overtime, bonus, commission, at say 60%. Now, your mortgage broker is the person who's going to be able to match you to the right lender based on your affordability and those rates. What we wouldn't want to do is go to a lender that uses 100% of all the income, but their rates are slightly higher than, say, someone who uses 60% of that income, but we only need to use the 60% with the lower rates. So your mortgage broker is going to be able to guide you what is the best rate for you. And number 3, look, guys, if it's going to reduce or you know it's going to stop in the future, there's absolutely no point using that income. All that's going to happen is you're going to overstretch yourself on your mortgage, and when that income stops, you're not going to feel comfortable paying for it. That's the worst place to be. So only use that income if you know it's going to be for the foreseeable future and you feel comfortable using that income. So the 3 things that you should be considering if you want to use any employed variable income is, number 1, your lender's going to average it out over your pay slips and it needs to match your P60 figure. Number 2, your mortgage broker is going to be able to match you to the right lender to show what percentage we need to use of that income to get you the best rates and the best mortgages available to you. And number 3, if you know at any point that that income is going to stop, there's absolutely no point using that income. It's just going to put a strain on your finances, and that's no place to be. So if you need someone to check out what your variable income can give you and how much that affordability is, just drop a comment below. Any questions, give me a shout.